Hey everyone, Douglas here, and welcome back to Applied MMT in this market recap for Thursday, February 22nd, 2024. All right, I have a jam-packed video tonight. We're going to discuss quite a few topics. I know I've been off a few weeks, so there's a few things I want to catch up on. Of course, right out of the gate, we're going to discuss market today up 2% on the S&P 500, 3% on the NASDAQ. All that predicated on the back of Nvidia and the earnings yesterday that came out after the close. Nvidia up 16%, so we'll touch on Nvidia. We will touch on kind of the broader market trend that we've seen going all the way back to the end of October. We've seen this massive rally. Big question, is it going to continue on from this point? My guess is we're likely close to a short-term top here. I'll explain why, and it'll also give me a good opportunity to show off one of the tools that will be very soon published over at appliedmmt.com, along with the rest of the dashboard tools. And brand new, it's a sentiment flow indicator, and I think it shows kind of unique insight and something that I've been wanting to piece together for a while now. So I'll show you that tool, and also why I think it's likely pricing in a bit of an overpriced, overbought market here off this, again, amazing rally that we've seen for the last 4 months. And then to tie together all of that, right, to kind of show the importance of flows, and I'll drive home that point a little bit more in just a second, the importance of flows and the underlying structural flows in markets and how they determine price. I'll also tie in a video that I made for Twitter that I think just kind of drives home that point, shows some of the deeper statistics and mathematical side of things that really are just kind of like at the bedrock, the base of everything we do here, and I think it'll be helpful. So this is going to be probably a pretty long update when it's all said and done, but like I said, I know I've been off a few weeks on the YouTube side of things, and yeah, I thought I'd make up for it in a kind of an extended update. So look, we'll get right into things. I'll skip the whole part about asking you to subscribe and turn the notification bell on and giving a thumbs up. We'll just get right into the good stuff, because I know you're probably already subscribed. Anyway, big rally today. Like I said, both NASDAQ and S&P up quite a lot. I think S&P made a new all-time high. That all off the back of Nvidia. I'm going to bring up the Nvidia chart as we kind of discuss Nvidia. Nvidia is really cool to me. Look, I'm just like a computer geek to begin with. I think I bought my first GeForce, which is one of their flagship products that they've had since pretty much day one. Nvidia GPU graphics card designer. I think I bought my first GeForce 2 back in 2001. So just as a computer geek, I love Nvidia. I also, they're just in the right place at the right time. They have these GPUs that are perfect for AI. We're getting this big AI boom in the last few years, and they are just the company that is taking advantage of all of it. The neat macro theme of all of this, though, and the great tie-in with the whole MMT approach is, this wasn't supposed to happen with 5.5% interest rates, right? The whole thing was, tech only succeeds, and we only had a great run up in tech during the 2010s after the post-Great Financial Crisis because of ZIRP and 0% interest rates and loose Fed monetary policy and all that nonsense. No, it never had anything to do with it. Flows are what matter. That is what matters, and clearly Nvidia, kind of taking over the world right now, can do so even in a high interest rate environment. Now look, AI is already revolutionizing the world. Is going to continue to do so, and there will be a lot of losers. At some point, we will have a dot-com bubble burst again, just similar to what we did in 2000. Now, whether that leads to a massive recession like it did after 2000, it remains to be seen. But there will be winners and losers, and you will get one day a realization that there was a lot of bubble speculation stuff going on. That will happen, but the point is, it has nothing to do with interest rates. It's just the normal ebb and flow of markets, and the only thing the interest rate thing is doing is kind of determining who the winners and losers are going to be. But I do really think with the AI thing that there's something real there, and right now Nvidia is at the spot where they can certainly take advantage of it the most, and they're profiting from it. Like I said, maybe Nvidia ends up becoming Oracle, or a company that never ends up really amounting to kind of what the promise is right now, but maybe they end up as the Amazon of AI, and they dominate AI. Again, the main most interesting point from a macro perspective is that this is all taking place. The entire AI boom is all taking place in a high interest rate environment, which every macro guru said couldn't happen. That only these companies like Nvidia can only really take advantage of a 0% interest rate world. It's not true. Companies can take advantage of any interest rate regime. it's just going to be different winners and losers. And in this case, the winner was Nvidia, and obviously we've been seeing a very strong bullish market to begin with over the last year and a half, and Nvidia has really taken advantage of that to become one of the dominant players now in the market space. Okay, so I think now I'm going to pivot to overall where our market's headed, and the same thing that's driving Nvidia is the same thing that's driving markets. Above all else, there are the core structural underlying flows are there, and the foundational flow, the first flow, is always government spending, and this is I've been driving this point home for as long as I've had this channel, and that remains the case. And we, all the way back in October, I made the call, and you can go look at the video, that at the end of October, flows, this is October 2023, flows were going to turn the corner. We're going to have a very strong end of the year, very strong start of 2024, and that I thought the market rally was just beginning. Little did I know we'd have this strong of a market rally. This thing's been unimpeded since effectively November 1st, but here we are. And if it's the flows that drive markets, then let's follow those flows. And look, if you're not a super active trader or active investor, and you're more kind of a market watcher, you're willing to kind of make moves, maybe get out of the way of a 2000 or 2008 or 2020, or maybe even like a late July through October 2023, right? If you just follow the flows, first and foremost, those fiscal flows, you can get a pretty good grasp of where markets are headed. And again, I think the video that I had back in October that said we're likely near the start of a major rally, spells out exactly why. But it's those flows that you need to pay attention to. But the problem is, sometimes markets do just get kind of carried away. Momentum can continue to just take markets higher, even if the underlying flows aren't necessarily there. Speculative rallies can continue on. And so I've always wondered, okay, can I look at something like sentiment, right? Instead of just looking at flows, what if I looked at sentiment instead of just flows? I have a lot of tools over on appliedmft.com that shows flows and price relative to flows, and using just specifically flows to predict price. But how can I know, even if we're in an environment like we are right now, a relatively bullish environment that still has overall strong flows, but when might we get a little extended relative to the underlying flows, right? When might we get into the spot where too many people are on one side of the boat and we might need to get a little reset? I think a good example of this was that run-up that we had back in the summer of 2023. July, we were very overextended. Sentiment was very, very elevated, and we ended up having a bit of a pullback. Now, at that same time, and I'm going to show you one of the tools that is available right now over at appliedmft.com, for members, and that is the daily treasury statement fiscal flow chart. And what I do here is I have a handful of different tools built into this, one of those being the green line here, which is the 90-day average of the net flow. So it's just the average of the last 90 days of net withdrawals for coming off of the daily treasury statement. That's the green line. Now the purple line, which might actually be a slightly better kind of visual, is just a moving average of a moving average, smooths out that net flow. And as you can see, it's a pretty strong correlation between those underlying flows and where markets are headed. And now what I want to show is what took place, and I think this is going to be a good example to have in mind when we look at the tool that I've created to show sentiment relative to flows. I want to take a look at what took place heading into the summer months of 2023. We had this big turnaround at the very beginning of 2023, which really lifted markets higher and kind of prepped them for that big run up into 2023, and those flows started to peak at the end of April. We had the tax drain that happened due to tax season, and they really leveled out as we were heading into July. Now, they did pick up as we headed into September and ultimately October, but we had this big mispricing that took place between flows, underlying flows in the market. And of course, as I mentioned, when you looked at sentiment was still sky high heading into July. So there was this big divergence between flows and sentiment. And I've always thought, I wonder if deeper pullbacks, maybe even pullbacks that get extreme to the opposite end, happen when sentiment is really misaligned with where underlying flows are. And that's what the essence of kind of the tool that I made that I wanted to capture. Are there big misalignments between flows and sentiment. So the sentiment flow tool that I created ultimately looks like what's on your screen. I'll kind of describe what's going on here. The red line is the sentiment ratio. So here's the idea, right? You have sentiment and you have flows, and you're going to create a ratio between the two to just kind of express, are we overbought, right, from a sentiment perspective relative to underlying flows, or are we underpriced relative to where sentiment is at, given where the flows are at that same time frame? Now, I did post a kind of comprehensive thread on Twitter that showed out kind of pretty much every one of these kind of major moves and what the outcome was. And does this thing bat 100? No. Is it built to bat 100? No. Is it a silver bullet in and of itself? No. But given where the rest of the context of where markets are at and understanding how this thing works, it is a very powerful tool. And I mean, I think if we look at this for a second, you'll see exactly kind of the power of what this tool actually is. And so we can just go over a few examples of this. The first one that really jumps off the page here is the February 2016 lows. Again, we had a market sell-off. Likely because of that, at that time frame, we had very low sentiment reading, and yet flows were very strong at that point. So we had a very high reading on the sentiment ratio, a buy signal. And again, anytime I'm going to say buy signal here, I really mean that in the context of the broader macro environment. If you're in a bearish market environment or a bullish market environment, that's important to understand, and we can know what sort of market environment we're in based on those core fiscal flows. Let's see. We then kind of dipped quickly into by September 2016. Into again a very low reading on the sentiment ratio, on the flow sentiment ratio, and that was before a steep little pullback heading into October. Just some other really kind of interesting readings here. We did get again a dip into sell signal before that 2018-2019 sell-off, and then subsequently right as we reached the bottom in December 2018, once again kind of getting that buy signal for the run-up that lasted us ultimately until COVID. More recently, though, what I really want to point out, where I'm going to kind of zoom on in now, is what took place in 2023 and why I think we're like the end of 2023, or I should say really that July to October sell-off in 2023 is we really just started to diverge sentiment-wise from where flows were at right at that time point that we were just looking at on the daily flow chart, and that is right around June heading into July. We kind of switched, the switch flipped, and we no longer had flows to support the relative sentiment given where markets were at, and we had a pretty steep pull down at that point in time. And I think that is really what I wanted to understand from this tool, is can it predict kind of outsized drawdowns, and that's exactly what it seems to be doing. And so we did have about a 10+% pullback from that July and a July high into those October lows. Interestingly enough, right after that, by the first week of November, this thing was already back in the kind of buy signal territory, showing us that likely we were into a new rally. So lo and behold, that's what took place, and kind of more confirmation for this tool. Again, it needs to be understood in context and where we're at, and I don't think that now I guess I should fast forward to today. We're now back in this kind of sell signal. I don't think this is the end of the market overall. We're still in a very bullish market environment, but I could easily see one or two things playing out from here. Either another maybe 10% pullback like we got from July into October, or maybe just a 5, 6, 7, 8% pullback from here, but it extends over time, right? Maybe a consolidation, maybe all the way through the rest of the spring, right? Maybe we don't get another big run up until the summer once again, and we kind of consolidate sideways, chopping sideways for a few months here. But one way or another, from what I'm gathering from this tool, where the overall market picture is at, to me, it seems like we're likely going to be pausing here for a while, consolidation sideways, at least a 5+% pullback, and then flows will kind of reemerge. We will likely get over too many people who were currently on the bullish side will jump to the bearish side. The bears will get too bearish on the bearish extreme, and then this indicator will flip to the other side, and then we will have a good run up heading in the summer. So that's kind of how I'm reading this thing. Again, either kind of an immediate pullback, or more likely kind of a consolidation sideways as we gear up for what will likely be some strong some strong summer flows. So again, the whole idea here, as I switch back to the flow chart, is looking back at what took place in that big run up heading into July and August in the summer months. We just didn't have the flows continue to that point. We had a bit of a divergence between price and sentiment. The signal came on the flow sentiment ratio. We got subsequently, not too quickly after, the opposite side of things, because sentiment changes pretty quickly. Flows were supportive, and the market was now mispriced to the low side, and that created that good buying opportunity that we pointed out again 4 months ago on the YouTube channel to get long here. And now once again we are seeing prices get a little extreme high, which is why, even though we had an awesome run up to this point, and Nvidia's doing great, where I do think this is a bit overpriced here, and I'm expecting a bit of a pause in market. So that is the flow sentiment tool, something I've been working on, and I think so far it's shown some promise given where this thing is at. And then of course the reading today is that we are quite overpriced here and kind of a due for a pause. Now, this whole thing is predicated on the fact that these flows actually drive markets, right? That this is not just a causal, or I'm sorry, not just a correlation, but also that there's some sort of causal element, which is exactly what I proved out in the Twitter video that I posted, that I'm now going to stitch in right here. So I'm going to go to that video. It's got some really good data science in it. Should really kind of drive home the point. Once you're done with that, I'll be back to wrap things up. Hey, what up, Twitter? Let's see. Yesterday, Carl Quintanilla tweeted out a headline that the U.S. is nearing half of the global stock market cap as a couple Chinese names are tanking. And I quote tweeted that tweet, pointing out that since the great financial crisis, the U.S. is up in government spending 250%, while the rest of the advanced economies of the world are up only about 50%. My point being here is that with the applied MMT framework, if you understand the applied MMT framework, you understand that when the government spends, it's adding net financial assets to the private sector. Those net financial assets go down one of two channels. Either one, they're saved. If they're saved, there's a strong institutional incentive to save that in the form of stocks because of tax-deferred accounts like 401ks, IRAs. If that money is spent, it becomes income for the person you're spending it to, or the company that you're spending it to. And that income boosts profits for those companies via the Levy-Kolesky equation. So when government spends, it becomes profits for the private sector. So either avenue you go, you're either increasing the value of stocks via the profits, or you're directly buying them, boosting the asset price. In other words, look, the thing I figured out day one when I'm MMT really clicked. Government spending, the residual of government spending is effectively stock market price, just kind of given the overall structure of how our economy operates. And so it's no surprise to me, going back to the tweet, that the U.S. is having such market cap dominance right now, because we're having such fiscal dominance right now as well. And in response to this tweet, one of my reply guys, he always replies, one of the MMT haters, said something to the effect of like, this is useless tweet, or useless information, or worthless tweet, or something like that. And I thought to myself, how do you know if something's worthless or not? How do you know if this is actually useful, right? It's just pure coincidence. Is this, what steps could we take? Any mathematical, statistical steps we could take? Is there any empirical way to actually show, like, no, actually government spending is not useless. It is actually a valuable, if your goal is to understand where stocks are going, which at least that's what I'm trying to figure out. If that's your goal, does government spending tell us anything about that, right? Like should we use government spending as a feature of understanding where, say, a target variable like the S&P 500 is going? And of course, if I'm making this video, what the answer is. But let's still walk through that process to show that, in fact, government spending is not worthless. There's actually a lot of value in understanding where government spending is at, if your goal is to understand where stocks are going, and if you want to do it in an empirically verifiable way. Now, look, if you don't care about an empirical method and validating the data that you're looking at, and you just want to, I don't know, read tea leaves, and that's your thing. Whatever. I don't care. But I at least want to know that I'm on good, scientifically verifiable ground in my thinking. And of course, the way that I know how to do that is with math and statistics when it comes to things like time series numbers, that sort of thing. So we're going to run through. These are the steps I take too. I mean, all the models I build, deep MMT, all the phase flow models, all that sort of stuff. I mean, these are the steps that I'm taking. Is the first step to identify what are called features in those models. Features are just the time series that I'm going to tell the model to learn on, and figure out what my target variable is going to be sometime in the future. And then how do I determine if I should add this feature? How should I engineer this feature to work in this model? And how can my model learn the most off these features? And is there anything to learn from that, right? I mean, that's really what we're trying to find out here. Is there anything to learn from this time series relative to what it is that we're trying to predict? So I have pulled up VS Code here. We're going to go over some Python. I'm going to explain it. I mean, I got charts up here. So even though we're going to go through a lot of code, I am going to explain everything that's going on. So pretty much what I've done up to this point, you're just going to have to trust me. I pull in a bunch of data, but then what I did is I've at least plotted the data so we can visually see what data we're working with. And we're going to run through two steps. One of the things we're going to do is we're going to look at what's called mutual information, right? So we're going to look at mutual information of that government spending and a couple of the other variables too that we'll want to look at that are generally thrown out there as important things to kind of keep track of. That might also tell us something about where the S&P is going to be at some point in the future. We'll run something called mutual information. That's going to tell us, is there information, kind of correlation, is there information shared between these two variables? And then we're going to look at Granger cause, which is just going to say, is there forecastability from one variable to the next, right? And if you have those two things, then you can put those in a deep learning model, and at least the model will learn off of those. Obviously, you want an underlying theoretical framework that makes sense, that's consistent, internally consistent, that sort of thing, which of course MMT is. And then once you start there and go to the next step, which is what we're going to do here, you can come to the conclusion that, yeah, okay, we can be fairly certain that there's something here. So let's go over these time series. Time series number one, adjusted MTS. What is this? All right, I pull the deficit data, right? This is deficit spending from the monthly treasury statement. It's easily accessible data from the Fred database. So adjusted MTS is just the accumulation of the monthly treasury statement month over month, and then that accumulation is adjusted for inflation. That's what the adjusted is. So what you're looking at is the national debt adjusted for inflation. Time series underneath that is going to be the change, the year-over-year change of that time series. So deficit spending year over year, and if you can see in this little time series here, right? There's the massive surplus, so the shrinking of the deficit year over year, heading into the dot-com bubble. Again, shrinking the deficit year over year when we got to the great financial crisis. Same thing as well in 2022. I don't have to probably explain to anyone watching this. When the deficit shrinks, that ain't good for stocks generally. So you can see the time series there. Again, a couple other time series we're pulling in. M2, very common time series that people equate with markets. M2 and the change of M2 year over year. Also pulling the Fed funds rate as well. And we'll also have the S&P 500 as our target, and then also the year over year change, the change or the return of the S&P year over year. And you'll see why that's going to be important in just a minute. The other thing I do too is I call this kind of like my noise variable, right? And what that is this is the average temperature of a city near me, going back to the beginning of all this time series. And the reason you want to do this is, especially when you do things like mutual information, you want that mutual information relative to like something else, right? In and of itself, mutual information can kind of tell you something, but it helps to use and understand the mutual information and what that value is relative to a time series that might also be giving you some sort of mutual information, than a time series that should just be noise, but also has some aspects of the data that you would actually like, right? So there's some cyclicality, obviously, to temperature data, and that's going to help us out. It'll make sense in just a second when we start showing some of the graphs. So the first thing we're going to do is we're going to pull all these variables into the mutual information test and then just plot them, right? So here's the plot of, now these are just the actual values. These are the levels of the time series. These are not the change or the return of the S&P 500 and the change year over year of the time series. These are just the actual levels. And what you see when you just apply our four series as the feature variables and the S&P as the target variable, you see that M2, monthly treasury statement data, the deficit spending, and the Fed funds rate all give us a lot of mutual information, certainly relative to the average temperature of a city nearby me during the time frame of our series. Now, there's a few things that this data isn't showing us. One this isn't showing us direction, right? This also isn't showing us the amount of information over some sort of lagged amount of time, and this is just showing the sharing of information between these distinct time series as actual levels. This isn't the change affecting, and of course we know in finance change is probably a little bit more important year over year, month over month than it is just the actual level, but we can easily see that these are giving us a tremendous amount of mutual information. What you don't want to take away from here is that, oh, M2 tells us, I mean, in this snapshot here over the 40 years of the data I pulled, without any time lags or without any variables, M2 is giving us more information. But what it's not doing is saying, okay, M2 is somehow more causal to stocks, right? It could be that the stocks are causing M2, vice versa. But all in all, what you take away from this is that, okay, these time series are giving us information about our target time series, and it's substantial enough where it passes the first test, right? And that's really what we're doing is at least get over the hurdle that we're getting some sort of information, and can we move along with some sort of confidence that we can run the next test. So the next test we're going to do is, I noticed how I took all those change of year-over-year change of deficit spending, of the Fed funds rate, of M2, and then ultimately the temperature average already was cyclical, if you will, so we didn't have to do a year-over-year change of that. But what sort of information do we get at? Now all of a sudden, because you're actually getting a change in temperature over time, you are actually getting a little bit of information, but we know that the change in temperature isn't actually telling us anything about stocks. I mean, maybe traders in New York are a little bit more happy this is being pulled from New York, but maybe temperature is affecting things. But for the most part, there's not going to be any connection there. So it is giving us a little information relative to the rest of the time series, but you're still noticing, clumping these three time series together, which are no one's going to deny, should have some information share. And again, this isn't correlation. That's important. This isn't correlation. This is just information. Is there a shared amount of mutual information between these two time series, right? Can you take this time series over here, the target time series, and get anything of that from these feature time series and understand how these time series work together? And the answer is yeah, you can, right? And it's still, given these three together, still a tremendous amount of mutual information between government spending, Fed funds, and M2. So we're good. Again, we got through the next hurdle. There's still something here for us to kind of dig into. What is going to be important next is to now see, is there any directional link? And we're just going to look at this deficit spending. That's what we set out to do. So at this point, we've at least understood that we have some information to glean between these time series, but what is it directionally, right? Is it the change of the S&P that is maybe causing government spending to go up or down, or is it my hypothesis that the government spending is in some way changing, or really how they say it in Granger cause? Is the S&P 500 forecastable by this feature variable, in this case, the deficit spending? So that's what we want to look at. One last time, we're going to look at our data sets that we're going to send into our normalization function. We are going to normalize this data. Actually, no. First thing we're going to do is we're going to take this data and actually look at the time series lag. That's what we need to look at. Does this change over time? Do we get any information increase over time? This is important. Forgot this was in here. Yeah, we do. This is really cool that after a year, we actually gain mutual information about our target variable. This is exciting, right? This means that the more time that this deficit builds up, the more information, up to almost 2 years later, we actually continue to get a build of mutual information between these time series as we lag backwards the government spending. So this is very cool. And again, one of the next steps you want to see is some sort of growth of mutual information over time. Now, you don't have to get this, but if you get this, and then you run a Granger cause, and the Granger cause is also showing forecastability from, in this case, the government spending, the deficit spending, the S&P 500, all of a sudden it's like, yeah, man, I mean, we're pretty close to saying there's something here. So we get this growth over time. Now, what you don't want to do is overread this. You don't want to say, oh, government spending is most impactful to stock prices, a year from now or something. Like, to a certain extent, yes, it's sharing the most amount of information between each other, but there could be, bidirectional causality, reverse causality a year later that isn't immediate, right? Maybe government spending hits immediately into the stock market price, that immediately boost within, let's just say 3 to 6 months of stock market price, and then a year later, because the stock market's going up, there's some sort of, again, reverse causality now going into government spending. Maybe instead of government spending going up, now you start getting government spending going down because the stock market's going up because tax receipts are higher, right? I mean, there's a million ways this could all play out. You don't want to overread this, but you're getting a cycle here, some sort of effect here of government spending that is growing over time for mutual information. So again, exciting, right? I mean, we're getting what we want, what we would expect here. I guess that's also the other thing too. What is our expectation? Yeah, this is what we're expecting. And if we're not getting what we're expecting, then maybe we do go back to the drawing board for our underlying theory. But so far, so good. We've crossed the first few hurdles. Now let's go to our last test, which is going to be this Granger cause test. Now we do need to normalize the data, right? We do need what's called stationary data. So we need to do a few things here. We need to make sure that the mean, we have a total mean of our time series of 0 and a standard deviation of 1. We also want to take out any seasonality. Effectively, we just want these things to look like sideways time series. So the Granger cause can do its thing the best, because it's picking points from each time series and effectively averaging where those points are relative to the time series over that time series to see, is there forecastability from one time series to the next. And again, I'm going to use that word one more time, forecastability, because the stat geeks, they're going to come in here. You're not running this. That doesn't say that one causes the other. I understand that. What we're just trying to say is, can I use one time series? Is government spending useless or not? And for information to forecast the S&P, right? I mean, that's what we're trying to answer. And so the final thing is going to be this whole Granger cause thing, which is just trying to anticipate forecastability. So again, we're going to look at our time series, just make sure they look good to the naked eye in terms of being stationary, which they do. We're happy there. And now we're going to run our Granger cause test. So first, we'll do a little drum roll here. We'll do them in backwards order. We'll reveal the answer that we're really looking for last. But we want to look in both directions, right? We want to see, does the S&P Granger cause government spending, and then does government spending Granger cause the S&P? So how you read this is a little backwards here, but how you're going to read this is adjusted NTS. So again, this is our time series. It's been normalized. That's the government spending. So how you're reading this is you're actually reading this as, and this gets kind of weird, but it's going to be, is government spending not Granger caused by the S&P 500? And what you're looking to do is reject that. So it's like more than a double negative at this point. In other words, does the S&P 500 Granger cause government spending? And so you're looking for a p-value. Again, the way I read it the first time, right? You're trying to reject the null hypothesis that I just read out. Long story short, you're looking for a p-value less than 0.055%, meaning that it's likely not random, right? You're likely not getting a random reading by the result. And we're going to go into this for 12 time lags, and lo and behold, you never get a reading less than 0.05. And so we can, for the most part, say that the S&P is not Granger, or does not Granger cause the, at least based on this test, under this methodology, does not Granger cause government spending. But again, drum roll, please. The other direction, the fun stuff. We'll go ahead and scroll down. Again, same methodology here, same test, just flipped on the variables. Do we get a positive Granger cause from government spending to the S&P 500? First 4 time lags, we don't, but scroll down a little bit more, and all of a sudden we do. At the 5th time lag, get what it is that we thought would be there, which is a positive Granger cause test. So yes, we can conclusively say, given this test, that there is forecastability of the S&P 500 by the target by the feature variable of government spending. So to answer your question, well, my question that we started off with, is this useless? Is this worthless data? If you're trying to forecast the S&P 500, no, it is not. Worthless, useless. There's actually value here. If you're not trying to forecast the S&P 500 and you're just trying to be a goofball on Twitter, then yeah, there's probably no value here. But if you're empirically minded, if you're data driven, if you really want to know the truth, this is really helpful. This is really helpful data. And of course, this is why this is really kind of the bedrock of all the models that I build, which is government spending. And it's no surprise to anyone Who knows how things work? All right, there you have it. Hopefully that clip was instructive. Look, at the end of the day, flows matter. They really matter. The statistics is there to back up the underlying claims of this applied MMT approach. And yeah, hopefully that was a solidifying little clip there. Look, if you're an active trader, active investor, you want access to these tools. Like I said, the sentiment flow indicator is going to be live very soon on the site after some finishing touches. We already have a plethora, a suite of tools, Deep MMT, the MMT flow phase model, and the vol shift, kind of our three flagship tools, if you call them. We also track other flows from the monthly treasury statement, margin debt, daily treasury statement, just a handful of tools that I use every day. The only tools that I'm going to put on here are tools that I have thoroughly vetted, that I know can lead to some real alpha. They are all available over at appliedmmt.com. So again, if you're an active trader, active investor, highly recommend checking that out. But I think that's it. I think that's all I got for tonight. We'll be back soon. Until next time, good trading, everyone, and we'll talk to you then. Bye-bye.